other corporate stories, and it's been a very strong second quarter number for Maharashtra Seamless. High realization seem to be driving the growth for them, and of course there is that bonus issue as well, which is exciting the markets right now. Saket Jindal, the MD at Maharashtra Seamless, then joins in on the show right now. Saket, hi, good morning. Great to have you on the show. Just wanted to understand what explains the buoyancy in your performance this time, and especially that after several years of subdued demand, especially after COVID nightmare, seems like the tide is finally turning for the sector.
Right, that's right. So the market is buoyant and exports are also robust. And we are supplying to the oil sector in India and also the PSUs. And they have shown considerable demand, and we are confident of maintaining a good order booking.
That's exactly what I wanted to probe a little bit deeper about, because there's several industry tailwinds right now which are working in your favor. Water infrastructure, demand from the oil and gas sector, petrochem, like you just mentioned. There's, of course, pharma and chemical sector as well, which continues to remain strong. But if you could just put a number to this, say over the next 3 to 5 year period on a CAGR basis, and how much volume growth are you working with?
Right. So we are doing more than 3 lakh tons of seamless pipes and approximately 1 lakh ton of ERW per year. And we have increased our production in the last financial year in seamless. And we expect to continue this in the coming year, around 15 to 20% increase.
Steel prices in India, there is a very big difference there. Post the export duty imposition. How has that benefited you?
Right. So the export duty has led to control in the steel prices, and that is benefiting to some extent. But even if there was an increase, we would have passed on to the end user. But at the same time, the margins would have been under pressure if the steel prices were more.
So my question is that for the quarter gone by, when your margins have expanded 18%, is this largely because the spot steel prices in the local market came down after the export duty was introduced? Have margins expanded because of that?
Yeah, that's right. To some extent, I would say the higher steel prices would have led to difficulty in absorbing the increase. So I'm sure the lower prices are helping to maintain our margins.
What are you planning to do on the cash pile you're sitting at? Will this be used for capex, or that will come back in form of dividend and buybacks?
We are planning some capex and in the setup. So in our facility in Nagar and also in our subsidiary company in Hyderabad, both the places, we want to do capex and to modernize our technology, and for also adding new product range in premium connections and also in cold drawn pipes.
All right. Now, given that approximately 17% of your revenue is via export, it has been limited due to the lack of pricing competitiveness of Indian SS pipes versus, let's say, that of China. So what is your outlook on how you see exports shaping up for the next 1 to 2 years?
Right. So recently the Canadian market has opened to us in OCTG, and that will help us to continue and increase our exports to Canada. And meanwhile, the exports to USA will maintain because of shortfall in supply from Russia and Ukraine. The demand window has opened up in these two countries. So there is no shortfall of orders in these two countries, provided our marketing and our the distribution is properly addressed.
So my follow-up question, perhaps the last question, Mr. Jindal, is that you're enjoying a lot of tailwinds, sudden demand which is coming from the oil and gas sector. China right now is in a shutdown mode, so no competition is coming from China. The extraordinary spread which you've enjoyed largely because of the duty on steel exports. Some of these factors may not sustain. China may soon open up. Oil and gas demand, if world moves into
Right.
a
So
recession,
China
could drop.
opens up. We are protected in the domestic through the steel policy and the oil and gas policy, where we are promoting Made in India through our government's initiative. And so in India, we are protected. Plus, in the surplus supply from China would largely go to Middle East, which is the main consumption hub for the Chinese products. So in USA and Canada, the competition would be very limited.
Thanks so much for giving us the view on your quarterly numbers, the export duty impact, and what the outlook is in terms of your margins. That's the word coming in from Saket Jindal.